In this video, I want to talk about my trading strategy in depth from the inside to out, why I consider it the best trading strategy, how I make the most amount of profits from it, how I protect my risk, and I want to go over where I come up with my levels, how I find them on the charts. So I'm going to break down and show you some actual trading examples, going over why I entered, why I exited, how I formed my levels, and I just want to come and debunk or break this down in depth of a simple equation or formula that I do use. Before we get into it, I recommend everybody watching this who has not already followed me on my Instagram. I will post a link in the description below to do so. It's a really good resource at Ameritrade. I post daily trading recaps along with really good trading tips and tricks that I guarantee you're not going to find anywhere else. Again, the link is in the description below. You're seriously missing out if you're not following it. But now, let's get right into the strategy. So let's first break this down into an equation. And how I came up with this equation is where plus when and why equals a trade. This is an equation, and without one side of the equation, we're not going to get the answer that we're looking for. So where plus when and why equals a trade. Let's first break down the where component, and this is essentially how I formulate levels in the market. So my where component usually comes from a supply or demand zone, a key level where the market has reacted to. This is key. So you want to come up with levels. It does not matter the time frame. It could be weekly, daily, 4 hour, 1 hour, 30 minute. You want to come up with levels where the market had a hard time breaking above or the market had a hard time breaking below. I label that as a key level, and the most important factor here is the market has reacted to that, and it served as an important inflection point. Also, I want to look for areas where buyers and sellers are factored in. Where is their large size? Where do I know many are long? Where do I know many are short? Where can I use this information that's going to give me an edge? This where component and all these things that I've mentioned are where I formulate my levels. These are my levels of interest to be present in the market. These are my advertisers to price. This tells me, hey, Carmine, the market's coming down into our level. Let's watch how price does. If price bounces or we find bids at a level where buyers were once factored in at, then that's going to be a good indication that's going to provide a high quality setup to take the market long. These advertise price to me. The market is an advertising mechanism. It's advertising good versus bad opportunities, fair versus unfair value. So our job as a trader is to read how the market is advertising price. We need to watch it here at this supply zone. So as I mentioned, I want to find large areas where buyers or sellers are factored in at. I'm going to replay this replay of the depth of market, and I want you all to keep a very close eye on this 4, 2, 3, 4 level. As you can see, there's tons of at-offer trades coming into the market at 4232. You can see a positive delta of plus 4,600, which means 7,000 trades hit the offer there, and only 2,400 hit the bid. So there's a positive delta of positive 4,600 lots at 4234. This is very strange. This is an area that I'm watching. Could it be a buyer? Because technically, these are aggressive market buy orders coming into the market. Absolutely. But the reaction after the fact is going to be the most important. So pulling up the heat map here are these large at-offer trades, which are aggressive market buy orders by these very large green bubbles. As you could tell, the market thereafter is going to find offers and sell off lower. So how I view this is an active seller in the market because the reaction after the fact led the market to sell off much lower. So even though these are aggressive trades to the offer, I view this as a very large seller into the market. Now I mark this as a level of interest and say, okay, 4232 is the area that we consolidated before we spotted those activity at 4234. During this day in the intraday commentary tab of the Discord, this is where I post my thoughts in real time as the market develops. We are watching the S&P 500 to move into 4132 to 4135 and reject. I would be open to shorting that rally, targeting levels below. It was simply a short-term trade idea where we were watching the market to rally into that level where we spotted those sellers and for sellers to step in and react to take the market short to capitalize on a downside move. Then later in the day, we rallied right into that level and reacted, sold off where we took the market short, targeting a quick 17-point scalp to the downside, targeting low a day. So the next one is just finding key levels that the market has reacted to that I had a hard time getting above or had a hard time getting below. The reaction there is key. So going over the pre-market plan on this day, let's look at the bullish scenario where we were watching a breakout above 4210, which is this green line on my charts over here. If we can break out long above that, confirmed by the tape, that's going to be the next aspect. I want to scalp long, targeting 4224 to 4232, which is that same level that I just went over with that large seller. Essentially now, what I'm doing is marking resistance points that if the market could get above X level, then there's nothing stopping a rally to hit Y level. Meaning, if we get above a certain level that is a resistance, a high, a low, whatever the case may be, if buying is strong through that level, then there's nothing stopping a rally into the next resistance or the next key level or next level of supply. So that's where I formulated that plan from, was if we can get above this resistance level of this green line, there's nothing in between this green line to this pink box that's stopping the market from rallying above into this pink supply zone. And then the last way I find levels is simple as just supply or demand imbalances. I love supply and demand zones. They are very powerful. As you can tell, we have a demand zone that formed on this day. Fast forward, the next time that it got tested, the market sold off into this demand zone 2 other times and had a nice rally off of that. And that is how I formulate my levels of interest. Now, the next component to this equation is when and why. When and why equals price and volume analysis. This has everything to do with reading the tape / order flow, reading the depth of market, reading footprint charts, reading a heat map, profiling, anything that has to do with order flow, or just simply reading the orders and the tape that the market is providing me. And I look for clues such as absorption, strong buying or heavy selling is what I label those as, acceptance or non-acceptance, and then trapped participants. These essentially are like the 4 main pieces of information that I look for while I'm reading the tape, using footprint charts, profiling, using a depth of market, reading delta, etc. This gives me my when and why I want to be an active participant. It says, hey, Carmine, we're coming down into our demand zone. Or hey, Carmine, we're rallying up into our supply zone. And at this level of supply, we're seeing heavy selling. We're seeing non-acceptance. We're seeing a lot of trapped longs. Well, that's telling me when and why I need to be an active participant. It gives me my confirmation and it puts the final piece of the puzzle together for that trade. It's my validator to enter that setup. Coming up with levels saying, hey, Carmine, once Tesla breaks $100, get long. Well, that's not good enough for me, because what if we come up into $100 and our plan was to get long simply because that level broke? But what happens? We break that level and there's sellers sitting there. Are we still going to sit there and take that trade long, even though the market's telling us sellers are present at our level we were looking to take the market long? No. That's why it's important to have levels of interest and then use price action to gauge what happens at those levels of interest. It validates that trade. It gives it valid confirmation. Without my advertiser and without my validator, my edge is not present, and I'm a spectator and I sit on the sidelines until both are present, that I have a valid edge and a valid trading plan with a valid thesis. So now that we understand this, let's go back to this trading plan where if we rally into 4132 to 4135, that's our where component, and reject, that's seller stepping in, when and why, then we're open to shorting the rally, targeting the low of day around 4220 for a very quick 12 to 15 point scalp, which was a very short-term idea for me. I love short-term scalping, quick momentum moves by spotting buyers and sellers on the tape. So now what I'm going to do is show you the chart, and you're going to see a really clean rally into that level and a really clean sell-off. But looking at the order flow and looking at the tape, I want you all to watch what happens at this 4232 level as I replay this little feature and go over here. We're going to rally into this level, and you're going to see offers step in, which means sellers are present into the market. So we see an offer right there for about 300 lots step in. And then we're also going to see very aggressive at bid and lower than bid trades, which means aggressive sellers are stepping into the market. We also see a ton of offers with a lot of buying into that level. Now, if I were to pull up a footprint chart, you're going to see the market rally into this 4232 level, buying into that level, and then selling steps in thereafter for the rejection lower. This tells me when and why I should enter that trade. As soon as you see this selling step into the market, that's your reason, that's your validator, and that's your confirmation to enter that trade short, play SPY puts, and capitalize on a downside move and short the S&P if you're trading the future contracts, because you had a really nice 16 point sell off to the downside simply using that concept that I've been explaining so far. Now, the next setup is what I mentioned earlier, that if we can get above a resistance level and there's nothing between that resistance level to the next supply zone or the next above resistance level, then I will take the market long above resistance if we are confirmed by strong buying there, targeting the next level of above resistance, because I'm speculating there's nothing in between the two that could stop price if the buying is strong. And you could also flip that to the short side if you're talking about support and you want to short a break below support. So this one was a break above 4210, which is this green line, to target 4232 or even 4244 for a very, very quick scalp to the upside. The market breaks this level, and now I'm going to show you the tape targeting that supply zone above. So here we have the heat map, and you can see the very strong green bubbles, which mean very large market aggressive buy orders as we rally up above 4,200 and as we're rallying before this breakout. We see all that aggressive buying. I even could pull up a delta footprint, and you're going to see a lot of blue, which is market aggressive buying as the market comes higher. Selling gets absorbed, meaning early shorts are getting absorbed on those pullbacks. They're getting bought up by buyers. And look what happens when we break out above 4210. The buying increases, the delta increases, and we get a really, really strong uptrending move directly into our 4232 target. Pulling up Bookmap, watch what happens when we break out over here. I'm going to speed up this tape. Keep a note on all the aggressive buying above 4210. Right here when we break it. See all that aggressive buying? Now, since we're above 4210, pullbacks have to hold, and it must be supported without moving very far away from that range. Eventually, this thing gets bought up, and we get that really, really strong rally with strong buying volume all the way up into our 4232 target, and we had a really nice 22-point scalp on our hands, coming up with the level of interest, having above resistance target the next supply of resistance, and using the tape to tell us why this trade should be validated. Now, most of the time, my exits or my targets are either low a day, high a day. They're the next supply or demand zone, as you saw from that example, VWAP, a key level of resistance or support, or just anything on the tape that tells me, hey, Carmine, sellers are here, or hey, Carmine, buyers are here. Get out of your position when you have profits, or cut it for a really small loss. So I would say 95% of my trades all come from these exits or these targets. Now, risk management is the most important aspect to any trading strategy. You should not be taking any trade that is a lower than a 2-to-1 risk to reward, meaning you are risking $1 to make at least $2 or more. 3-to-1 is better, 4-to-1 obviously is much better. However, I will take any trade above 2-to-1. Your exits, your stop outs, where you're going to place your stop loss. It is when your analysis is proven wrong based off the chart, not a dollar or a percent amount. And you do this because you're not going to feel small losses when your wins are 2-3 times greater than your losses. So your $50 loss, you're not even going to know about it if your winner is like $300-$400. Or your $1,500 loss is going to be nothing if your winners are $3,000 to $4,000. So you see where I'm coming from here? And on this setup, the long above 4210, the stop loss for this trade was below this low right here at 4202. So I got long 2 points before that 4210 break when the buying stepped in, which means my risk was 6 points. My target was 22 points higher. That's over a 3-to-1 risk to reward because I was targeting the supply zone. You want to position yourself that when you are incorrect, your losses are small as possible and your winners are going to take care of themselves. The other trade, when we got short at supply, if our entry was pinpointed, and it really depends on your entry for any strategy, then a valid stop loss would have been above this high, right? So we're risking about 3 or 4 points to make a potential 10 points to the downside. Really good risk to reward. However, if we're getting short, waiting for better confirmation, let's just call it at 4230, 4229. Then a valid stop loss would have been above this high because now our risk is much smaller and we're still keeping the same reward below low a day, which is about 14 points lower than that. So you always need to position yourself to win even if you are incorrect. And this is how I trade. Obviously, I could go on for hours and hours with this. By the time you're watching this video, in the next 2 or 3 days, there's going to be about 13, 14 new videos and over 5 hours worth of added value to the A to Z course about order flow, reading the market auction, the tools that I use, and actual live trading examples going over exactly what I look for on the order flow. I'm going to end the video on that note. I hope you all understand my where plus when and why component equals a trade. If you have any questions, comment below. Drop a like on this video if you learned something, and definitely check out the links in the description below. But I'm ending it. Peace.